Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about KB Home Quarterly Report. KB Home provides a range of businesses and services, including building and selling single-family residential homes, offering townhomes and condominiums for various homebuyers, mortgage banking services for homebuyers, property and casualty insurance products, earthquake, flood, personal property, title services. KB Home's stock price drop. A confluence of negative factors in the past year, KB Home's stock price has plummeted by over 26.69%, driven by a combination of disappointing financial results, reduced forecasts, and broad concerns within the housing market. The company's weak first-quarter performance, marked by missed analyst forecasts for earnings per share, EPS, and revenue, was a significant contributor to this decline. KB Home's reliance on first-time homebuyers makes it vulnerable to fluctuations in interest rates, which have intensified affordability concerns and led to delayed home purchases. The company's business metrics, including declining orders, deliveries, and an increasing cancellation rate, further underscored the weakening market demand. Analyst downgrades and reduced full-year guidance also weighed heavily on the stock price. KB Home's decision to expand its lot portfolio despite weakening demand signals left it exposed with a large inventory in a softening market. The confluence of these negative factors has led to a significant decline in KB Home's stock price, making it an uncertain investment opportunity for potential buyers. The primary drivers of revenue growth or decline can be summarized into three main categories. Revenue growth is primarily driven by an increase in Section 45L tax credits and a rise in equity income from unconsolidated joint ventures. Additionally, the Southwest segment has seen a significant increase in revenue due to higher home deliveries and average selling prices. On the other hand, revenue decline can be attributed to several factors. A decrease in homebuilding revenues is largely due to lower numbers of homes delivered and reduced average selling prices. Higher relative land costs, geographic mix shifts, price reductions, and homebuyer concessions have also contributed to this decline. Furthermore, a decrease in insurance commissions and title services revenues has also impacted revenue. Interestingly, there are some neutral factors that have not significantly affected revenue growth or decline. These include lower construction costs and decreased operating leverage from lower housing revenues. Net income and profit margins decline. A summary of the changes: the net income and profit margins of a company have experienced significant declines over the past year. In Q3 2025, net income decreased by $47.5 million, 30.2%, compared to Q3 2024, while in YTD 2025, it dropped by $137.1 million, 29.6%. The profit margins also suffered, with homebuilding pre-tax income margin decreasing from 11.2% in Q3 2024 to 8.3% in Q3 2025. The main reasons for these declines are lower housing revenues, higher relative land costs, reduced operating leverage, and inventory-related charges. Additionally, the company's housing gross profit margins decreased from 20.6% in YTD 2024 to 18.2% in YTD 2025 due to price reductions, geographic mix changes, and increased inventory-related charges. These factors have collectively contributed to the decline in net income and profit margins, indicating a challenging period for the company's financial performance. Despite some discrepancies in the financial summary, it appears that the company is indeed generating positive operating cash flow. The majority of the extracted summaries from various pages confirm this trend for both years 2024 and 2025. Specifically, the company reported positive operating cash flows of $3,089,000 and $10,117,000 for the 3 and 9 months ended August 31, 2025, respectively. This suggests that the company's operations are generating sufficient cash to cover its expenses, indicating a healthy financial position. The company's debt level has experienced a notable increase. According to financial records, notes payable rose from $1,691,679 to $1,943,582, representing a 14.5% growth. This significant rise in debt is evident across multiple pages of the summary. However, there is no clear indication that interest expenses have changed significantly, with some pages failing to report this information directly. Management's outlook on company strategy. the company's management team believes they are well positioned to achieve their updated projections for the 2025 fourth quarter and full year. However, they acknowledge a decline in revenues due to decreased insurance commissions and title services revenues. To address this, they plan to scale back investments in land and land development while maintaining a level of investment that supports current growth projections. Management expects ongoing affordability concerns and cautious consumer sentiment to temper demand in 4Q 2025. They will focus on generating net orders that maximize margins, returns, and cash flow over volume. Housing revenues are expected to be lower in 2025 compared to 2024, with a projected range of $1.6 billion to $1.7 billion in Q4 2025. The company's management team is cautious about forward-looking statements, noting that actual events and results may differ materially from those expressed. They anticipate maintaining sufficient cash flow to fund operating and land-related investment needs for at least the next 12 months. The company's financial summary reveals that they have engaged in two key shareholder return initiatives. Firstly, the company has paid dividends to its shareholders on multiple occasions, as noted on pages 16, 34, and 52 of their financial reports. Secondly, they have also bought back shares from the market, with evidence of this activity found on pages 16, 37, and 48. Concerns about inventory buildup or supply chain disruption. A growing issue. The recent financial summary highlights growing concerns about inventory buildup and supply chain disruptions. On the inventory front, there are several red flags. The company has seen a significant increase in inventory impairments, with charges rising from $3,685 to $18,351 between 2024 and 2025. Inventory levels have also increased by $310 million over the same period, indicating a potential buildup of unsold goods. Furthermore, the aggregate carrying value of impacted inventory stands at $26.7 million, suggesting that the company may be struggling to sell its products. The increase in consolidated inventories and inventory-related charges also points to a potential problem with inventory management. In terms of supply chain disruption, softer market conditions are expected to pose challenges for the industry. The decrease in lots owned or controlled by 15% from November 30, 2024 to August 31, 2025 is another indication that the company's supply chain may be experiencing difficulties. Additionally, the year-over-year decrease in ending backlog of 24% and value of net orders for the 2025 third quarter, down 15% year-over-year, further supports this concern. Overall, these concerns suggest that the company may need to reassess its inventory management strategies and supply chain operations to mitigate potential risks and ensure business continuity. That concludes the financial summary for KB Home. Feel free to comment below, and I will be happy to answer them when possible.